Hey there, everybody. We are live. I have a lot to talk to you about today. I'm Mitch Goldberg with Client First Strategy. I'm a financial advisor with 30 years of experience, and you're watching a new episode of Be the Boss of Your Money. This show, this live stream is all about helping you become your best possible version of your financial self. Welcome to the live stream. And if you're watching this in the replay, I'd like to welcome you as well. I would love to hear from you, so please ask any questions that you may have in the comments below. Certainly, words of encouragement are welcome too. So first, we're going to talk about a couple of things. A few points on required minimum distributions, a few points about the stock. We're going to actually talk about this rally quite a bit. Coronavirus stocks, presidential candidates, and I think that's actually a lot to talk about in about 20 minutes. So let's roll the introduction, and then we are going to get into some heavy stuff. You're going to like this because I think this rally has some staying power. Okay, and we are back. Thank you so much for joining me. Couple of housekeeping points, first of all, okay? This is going to be my last broadcast for this week. Passover, as you know, starts this evening, so in a little while, I'm going to be getting into a Seder and then digging my teeth into some brisket, and it's going to be really good. Especially since we're our third or fourth week, depending on where you live, into the social distancing and quarantine. I'm in the mood for some good food that I'm going to enjoy and be able to kick back and relax. Tomorrow is the second night. Friday, the market's closed. It's Good Friday. So I'd like to wish everybody a very happy Passover, a sweet Pesach, as we like to say. I'd like to wish you a Good Friday and a very happy Easter. And let's all come back strong next Monday, see what the world is like, and maybe count some blessings in the process. So first, I want to talk to you about the overall market. Today was a significant day. The major averages were the Dow and the S&P were up about 3.4%. NASDAQ was up about 2.5%. These are big days. You had a nearly 800-point rally in the Dow. So the question is, does this have sticking power? Does it have or is this just another rally that's going to fade away? So yesterday, the major averages were down slightly, not even 0.1%. But I said that was a disappointment because they were up a lot more. They were up about 3% at one time, more than 3% at one time during the day after a substantial rally the day before. Okay, so we're Wednesday. We added up. We had a big up day Wednesday, a big up day today. I mean, a big up day Monday, a big up day today, a flat day yesterday. So far, we're killing it this week. I mean, this has been a really good week so far in the market. No complaints, okay? No, you can't have any complaints about this. I normally don't like the big rallies. I know what you're thinking. Well, how could you not like big rallies? I don't like the big down days either. I don't like when you have a big rally and it's followed up by a big down day, or a big down day that's followed by a big phony up day. It's, I don't think it does anybody good. And we need to find a balance. We need to find the right, price discovery is the way I would put this. So if you see along the scroll at the bottom here, will the market rally finally stick around? Coronavirus stocks, what happens if you skip your IRA minimum distribution? And we're going to talk about that. So what was the spark to today's rally? Okay, the main spark is the coronavirus stuff. Okay, so I'm going to share the screen with you. Share screen. All right. Share. So first thing we're going to do is we're going to put up a chart. You see this? This is the pace of the coronavirus outbreak, okay? The number of reported cases, all right? Reported cases rising faster than other countries, blah, blah, blah. The point is this. The yellow is the United States, and we were going up this straight line, and you see to the red, that's where the path we were on. But if you see the green, you see the yellow curve is starting to bend. And we're heading toward the green, which is a flat line, which is similar to China, South Korea. And it's the same thing is happening. The curve is starting to bend in number of new cases around the world. The outbreak is starting to lessen. Listen, I'm choosing my words carefully. I don't want to come out and say it's good news that people are still getting sick, that people are dying. I'm not trying to say that, oh, there are fewer deaths. No, that's not what anyone is trying to say. The stock market is a discounting mechanism. In other words, if the news is getting better, stocks will react positively to that. In this case, with the coronavirus. And it's always good news to see fewer cases, fewer COVID-19 positives. And it's always good news to see fewer deaths. Obviously, the best news is if there were no more. But what I'm pointing out to you is if you take a look at this chart that's up here. Okay, excuse me, I have a little thingy on my screen. I turn off my email, but the calendar keeps popping up anyway. So this is why it's so important not to get overly pessimistic, okay? Because what you're seeing here in the charts is that coronavirus numbers are starting to smooth out a little bit. They're starting to, the curve is bending. So that's a pretty significant thing. What's the other news? Okay, you saw this. Let's go over here. You see here how the Dow is up. Dow surges 700 points as Wall Street rally gains steam, and it gained steam into the end of the day. I just want to make sure my gauge, okay, the gain is up enough. So if you have any questions, by the way, please ask away. So the presidential politics played a role today also, a very important role. This is significant. Bernie Sanders, if you haven't heard by now, has dropped out of the Democratic primary. Okay. So that just leaves Joe Biden as the presumptive nominee for the Democrats versus President Trump in the next general election. Both of those candidates are considered to be market friendly, economy friendly. Okay. And I don't think you would say that Biden is quite as market friendly maybe as Trump, but we could debate that another time. The point is, it takes Sanders' policies from creeping into the political foray. It takes away Medicare for all. So that is, to a lot of people, a good thing. And it should, business owners were worried about higher taxes, et cetera, because of the very dramatic policies that Sanders had been pushing, that he stood for. Okay, no kick against him or his followers. Okay, but what the market interprets is that now you've got two presidential candidates that are considered market friendly, and so that removes some of the political uncertainty of how the stock market and the economy could react to that. So that is why you saw such a good rally today. But I spoke today. A little humble brag. I was asked to speak before the FPA, Financial Planning Association, Long Island chapter. So I spoke on a Zoom call today about the economy, how I'm positioned, stocks, and we spoke about bonds and interest rates, and all of these things. And it was so CFPs can get their continuing education credits. I was happy to be a part of it. I was very flattered to have been asked. And one of the things I said is if we actually see a sustained bending of the curve, of the coronavirus curve, infections, hospital admissions, death rate, you could see the Dow go up, 5 to 10,000 points. I mean, 10,000 points maybe is a stretch, but you could easily see it go 5,000 points. And what I had said a few weeks ago, remember we had the March 23rd low, and then I said I came on air, on stream, and I said March 24th, I said, I think we saw a bottom. I think we saw it. And if we can get rid of the health crisis, we can solve the financial crisis. And I'm not saying that the economy snaps back like a rubber band to what it was, before the crisis. It doesn't matter. Just being confident to know that we'll get back is enough to send stocks higher. Where people say, "Oh, it'll take a long time to get back to normal." Oh, we'll still have a lot of problems and a lot of drag in the economy. It could take years. Doesn't matter. As long as you know the good news is coming, the market will discount that. Stocks will discount that. They go back up. And if you combine that with all of the stimulus, monetary stimulus, the Federal Reserve will buy so many different kinds of assets, unlimited amounts, literally unlimited. QE infinity is what we call it on Wall Street. The Fed has done more in a 2-week time span during this crisis than it did for all of the entire 0809 Great Recession. And then you have the CARES Act, the Secure Act, but mostly the CARES Act, the Payroll Protection Program, the EIDL. You have all these programs, you have all the stimulus coming in. You combine that with an easing up in coronavirus issues. The economy doesn't have to get fully back on its feet, just a little. You have the ingredients for a much higher market. And that would mean that this entire sell-off was a panic-driven sell-off for naught. Now, I could be wrong. I'll be the first to admit that I was wrong. The market went down. We hit a new low. Okay, fine. It actually doesn't change anything that I do for my clients. I don't invest my clients' assets and update their plans based on if I think the market's at a top or a bottom. I said this in that FPA presentation I did also. I said, we'll leave the bottoms and the tops to the people who sell the clothing. We'll leave the market to us. Okay. I don't depend on market tops and market bottoms to do a good job for my clients. We invest based on an asset allocation, a risk tolerance model that's appropriate for the client. We don't just buy stock to stock. We take a portfolio approach in every decision we make. I don't just buy stocks just because they went down and they should go up. I buy investments in my clients' accounts based on what is a proper fit to the account. It's a very different story than just saying a stock that went down could go up, or buy something just because it went down. Because if a stock keeps going down, you'll be kicking yourself. Why did I buy this? But if it's if it plays a role in your overall portfolio and it has a fit with the rest of your investments, then it was the right decision no matter what. And that is the position we like to be. I think it's much more prudent and sensible. Okay, let's talk about the COVID map here. Okay. I just punched this up a few minutes ago. So this here is for the United States, 419, let's call it 420,000 total confirmed cases in the United States. This is the Johns Hopkins Coronavirus Resource Center. It's updated continuously throughout the day. We have on the right 23,000 confirmed people, recoveries from COVID-19. The number could be a lot higher than that because there are people who were asymptomatic. There are people who didn't have tough symptoms of the infection. But this is what's been reported, okay? Deaths, 14,000. It's a heck of a lot. It's a gruesome number. I wish it never happened. But, I'll show you that I showed you the curve before, though, that we're starting to maybe get a handle on things, that the social distancing is starting to work. Even Dr. Anthony Fauci, who's been incredible, to me, he's been the voice of reason in all this. Even he says maybe things might not be as bad, but he's also very quick to point out, don't let your guard down. We can't become complacent. We don't want to have a rebound. We need to keep up the power that we have over this virus and keep social distancing, stay safe, stay home. Don't forget. Okay. So let's talk about required minimum distributions. Okay, first of all, everyone's getting a break for 2020, so you don't have to worry about taking your required minimum distribution while the market's down a lot if you don't want to. My preference is that when you have a required minimum distribution, over the next few years, that money typically with my clients would already be sitting either in something very stable or cash equivalents well ahead of the timing of when clients would need to take the money out. This is really important because inherited IRAs are a big thing. Okay. People have amassed big amounts of money in their IRAs, and you have inheritors. If you inherited your IRA last year or earlier, then you can take out IRA distributions according to your own actuarial lifetime schedule, which means you basically have years and years, a lifetime to take the money out. But if you inherited an IRA this year, inherited IRA, you do get a break for 2020, but you do have to take all the money out over a 10-year period. A lot of people don't like that. They want to leave the money invested longer, have it grow longer, make it part of their estate plan. So there are some pretty big things. If you miss an IRA distribution, you have to pay you have to pay the taxes on the IRA distribution as if you took the money out, and you have to pay penalties. So you don't want to skip an IRA distribution, but what you need to do is check with your CPA to know exactly when you have to take it out. Now, if you've already been making required minimum distributions because you turned 70 and a half last year or earlier, you have to keep doing that. But if you turn 70 and a half this year, you don't have to take your required minimum distribution for another until you're 72 and a half. So you have a little bit more time to take your IRA distribution. Some people it's important, and some people it doesn't matter. They have to take the IRA distribution, but you have to do what's best for you. But you should know. You should know. Okay, this is important information that you should know. Not all of my clients are at that age group, but enough are that it's something I know a lot about. Okay, what else? As far as the stock market goes, I'm going to stop sharing the screen. Stop screen. Okay, you have me back. Okay. If you take a look at the market here, Tepper, Kramer, CNBC, Kramer CNBC personality, Jim Kramer. And if you look at Mark Cuban, they've all come out and they've said they don't trust this rally. Yesterday, I think it was David Kostin from Goldman Sachs. A number of heavyweights have said they don't trust this rally we've had, and they don't trust this rally we've had off the bottom. Okay, so I think it's a reminder that there are different opinions, different viewpoints. Everybody's entitled to their opinion, and we don't knock people for that. In fact, if you made some crazy known some crazy viewpoints a few months ago that we're going to have this massive volatility, nobody would have believed you. So we can never be complacent. So even though I'm saying I think we may have seen a low, maybe it's just a near-term low to be retested. But I'm still hopeful that I think that as long as we see these numbers come out a little weaker in terms of the coronavirus numbers, we'll continue to get to those points. So I'm going to take a quick look now and see who is out there in the world. And I usually have this up before we get started, but that's okay. We're going to do this. We're going to do this now. We're going to do this right now. We've got a few people out there. Maybe the weather is nicer. I'm wondering if as the weather gets nicer, if there are going to be fewer people, watching my my live streams. Worst things have happened. So, hey, Mark, you're out there. That is awesome. It's nice to see you, Mark. I remember we used to sit and talk about real estate. It was like 10 years ago, right? You, me, and Paul. So great to see you. Hey, Eric Hagen, my fellow comrade, my fellow financial advisor. Thank you very much for being here, and I'm really glad you are. I have to have you on as a guest soon. We have to try to get that together. Got a few people out there in Facebook land. So, hey, Rich Martino, thank you so much, man. Thank you for the happy Passover wish. I'd like to wish you a very Good Friday and a very happy Easter. Wishing you peace and love, my friend. Hey, Keith, U-shape, V-shape, or W-shape recovery. Okay, so yeah, man, mother of mercy. So one of the things that I talked about in the FPA talk in front of the Financial Planning Association was different letters, like a V, a V recovery. I did some sketches, see that, Keith? A W recovery. And then we talked about maybe a check mark recovery. You see that? You see the check mark recovery? And I already took notes on this, but I posted this on LinkedIn before. This is my shape recovery when it comes to a V or a W or a U, okay? So let me show you. I put this up. Okay, you see the orange arrow, stock market recovery, the beginning of the bear market and the end of the bear market, and I have just all over the place. And I was being facetious, but it proves a point, because the reality is we have no idea if it's going to be a V-shape, W-shape, sawtooth pattern, check mark pattern. lightning bolt down, lightning bolt up. So that's why I just went. I went with the scribble. Okay, because this is the honest one. We don't know, and it changes day to day. Right now, today, I think people are talking about a V-shaped recovery. Yesterday, people were talking about a W shape, or when the recovery, market goes down, goes up, goes down again. And I don't know if people are talking about these recoveries for the stock market or the economy, but I think right now they're pretty much considered one and the same when we talk about these recoveries. So I just went with the squiggly line. It's the honest answer, because whatever happens during the day is what determines people's view of what letter or shape we're going to use to describe the economy. So I'm just going with the squiggly line because we really don't know. And it really doesn't matter to me. As long as we get through it is all I really care about. Okay. Hey, Bill, good to see you. And Zisen Pesach to you, my friend. Thank you very, very much. And yes, Filippo, I'm going to answer your question right now. So I'm going to show Filippo's comment. Do you all see that? Okay. Filippo says, Mitch, love to hear your thoughts on emerging markets and international equities. I love ETFs, and USA-based equities have been amazing last 5 years. Emerging and international, not so much. As a young investor, I feel like I am getting impatient. Seems like none of the funds, except for US equities, grow over time. I've been investing for over 10 years now. This is my observation. Well, it's a darn good observation, and the reason it's your observation is because, you're right. It's been a lousy 10 years for international investing. I mean, Europe has been dead money for years. Emerging markets, they always seem to show promise and they get beaten right down. But before the Great Recession, emerging markets were a really, really good place to be. One reason emerging markets haven't done so well is because of commodities, price of oil, price of copper, aluminum. When commodities are cheap, a lot of emerging markets rely on exports of their natural resources. So that is a very big part of it. As far as China goes, I just want to say, I don't know if I really consider China an emerging market anymore. I mean, it's the second biggest economy in the world, but a lot of emerging market funds have a very big exposure to China. But having said that, I'm with you. It's been frustrating, but that's the problem with diversification. And diversification, by the way, is a strategy that we use to reduce risk, but it doesn't necessarily prevent your portfolio from going down in a generally down market. Just have to get that out of the way. And an index, by the way, like the S&P 500, you cannot invest directly into an index, but you could invest in a security that tracks or mimics an index. Ooh, boy, I just have to get those in there so I satisfy some compliance requirements. It's not onerous to satisfy the compliance requirements, but you have to do it because, compliance officers are willing to, let me play ball, and they give me the rules to follow. So, I don't make the rules. I don't break the rules. So that's the idea. The idea is it's a compromise. And if you had cash in your portfolio, that would have underperformed for the last couple of years. And now, cash in your portfolio, money market or cash equivalents, that's the best thing in your portfolio for the last few months. It won't be the best thing in your portfolio forever, but nothing is the best forever. Ultimately, over time, risk investments like equities, stocks, whether it be small cap, mid cap, large cap, international, they do well over time. I think it's fair to say that international is due for a good cycle. I think the group is washed out. I think it's underowned. And I think you should stick with it as part of a diversified portfolio. Like I said before, this isn't a matter of just picking up a couple of country-specific ETFs or just a general emerging market ETF because you think it's cheap and you can trade it. I think it's still an important part of a reasonable asset allocation / diversified portfolio. So I wouldn't give up on it. It's just you have to compromise. I mean, what if you put all of your money into just American equities and American equities underperformed? There's something called home investor bias. Yeah, something to that extent. Okay, home bias, where we have a tendency to prefer to invest in our own country, and for good reason. By the way, the United States over time has been, a great place to invest, and I don't think that changes. but I don't think the need for diversification changes either. Hey, Phil, how are you? By the way, Phil, I owe you one of these, man. I owe you and Deborah a heart. Just I was scrolling Facebook. It was like the middle of the night. I was trying to fall asleep, and I saw that beautiful picture of Deborah and your dog, and just gorgeous, absolutely gorgeous, both of them. So I just wanted to share that with you. Amazing answer. Thank you. Filippo, thank you very much. That was quite an answer. And while I'm here and looking on the on the LinkedIn, okay, Sririam has joined in. And thank you very much. You've always been so supportive. I really appreciate that. And even though I could see the Facebook comments, I just want to see if I've gotten any other reactions while I'm into the Facebook. Okay. Is everybody social distancing and staying safe and doing all those important things? It's very important. We've got a few other people out there, and got a couple of reactions out there. You know what? This happened to me yesterday too. I want to see the reactions. I don't want to see all the comments right now. But I know Judy's out there. Hi, sweetie. Hi, Jesse. Love you. My daughter's Jessie, and she always watches and asks me to give her a shout out. So I'm doing just that. Okay. So do you have any questions for me? If you do, please let me know. If you think of any questions, coming up, after this, let me know. I think that's it. I think we've covered a lot. To sum it up, this rally, it went up for the right reasons. So I'll sum it up like this. I expect the economic news to continue to deteriorate. What people thought originally was that the coronavirus news would be worse and the business news wouldn't be so bad, but it turned out they're both terrible. But the coronavirus news is actually as bad as it was. It's not coming in as bad as expected, but I think the economic news will continue to be bad. I don't think it's going to matter that much because people see light at the end of the tunnel. They see us getting through this, and the market will discount that and rise on it. So for those reasons, I think today's rally is very, very justifiable. And that's why I think this rally could stick around for a little while. So that's it. I'm sticking to that story. If you have any questions, reach out to me. I'm going to end this broadcast. I will be back next Monday at 4:30, and I'm sure we're going to have a lot to talk about. Thank you very much, and just have a great weekend, great holidays to all.